Hey everybody, Courtney Smith here. I want to take a deeper dive into Tesla. We're going to look at it fundamentally. We're going to look at it technically. And I just picked it because it's such a hot stock that everybody's talking about. So let's start out first with the fundamental. Let's start with the technicals right now. Then we'll go into the fundamentals. So this chart here is a daily chart. It's going back a couple of years. And you can see when the stock first broke out back here in early 2020, we had the dip. There's the COVID dip. It looks pretty small now, doesn't it? And then we embarked on a major bull run. We accelerated the rally here, coming up into this high. We took a little dip and then took off to the moon. Now, since last week, of course, we have collapsed down. We left a gap here today. I think it's going to end up as heavy volume. Don't have all those figures out as well. So I put a line here, a trend line. Trend lines are not the best indicators in the world, but nonetheless, here it is. But here's three significant lows in the market where this red line is. So right now, I'm saying that we're going to dip. The dip will end inside this support zone, and then the bull market will start to resume again. Now, let's take a look at the fundamentals for a second. So let's look all the way over here to the left, and we see that analysts are expecting earnings to grow by 1,000% this year. That's not bad. No, that's fantastic. And then 43% next year, both very good. This year, you see the little green triangle. The little green triangle is pointing up, saying that the analysts are actually raising their expectations for this year. So that's bullish for sure. But the red triangle says they're lowering for next year, and that's not bullish. The price earnings ratio is 283. Now, 283 is fine if we're going to actually increase our earnings by 1,000%. But let's take a look at it again. If we raise the earnings to, let me just round that off to $2, and let's say the price is $3, just to round these numbers off to make the math easy, that's a PE of 150. Still too high, because what you want is the PE over the long run to be equal to the earnings growth. Okay, earnings growth equals PE. That's a good thing to have. You could have the PE a little bit higher, but you don't want it that much higher. So next year, 43%, that's great. It's declining, and it's too overvalued, the stock. Now, let's keep going, and we'll come to a conclusion. So earnings per share rating is 78. That means it's growing earnings faster than 78% of companies. That's good. Down here, this RS rating over here on the right-hand side, that says that the stock price over the last year is stronger than 99% of stocks. Now, if they had the figure, what about the last week, it would have been one of the worst performing stocks. But over the long run, it's been very good. This bull market is very, very powerful. Let's take a look at a little bit more detail. Now we're looking at a weekly chart. So every bar is 1 week. And let's come down here, right here. Management owns 23% of this company. That's good. Most of the time in public companies, management doesn't own 50% of the company or more. They own less. And in mature companies, they'll own 3% or less, like General Motors or General Electric, or Apple for that matter. But here, management owns 23%. Now, that's good for us investors because it means that management is going to look at things as a shareholder as well, as an owner of the company. And so if they're a shareholder with us, they'll look out for us as well, generally speaking. All right? Banks own 1%, no big deal. Now, this is a bullish factor. Funds own about 39% of the company. But on a mature company, they'll get up to around 70%. So there's actually, funds could buy this a lot more. So there's a lot of pent-up potential buying with funds. And you start to think when it gets up around 60% or 70% that they pretty well bought everything that they were going to buy. So let's go back over to the daily chart. So we've got ourselves our support zone down around here. Let's call it around $300, give or take $20. So right around $300. Now what we saw was a mixed bag going forward. Price is overvalued. Earnings growth is good, but still not good enough for the PE that's being charged for the stock. And earnings per shares are going down. But the funds could still buy more to catch up. So what do you call that? A mixed bag. It's not that great, either the bull side or the bear side. So I look at this and I say, we've probably seen the high in Tesla for a year, something like that. We'll come down to $300 and then we'll start to consolidate. And we could be in a range of, say, 260 to 400, something like that, grinding. The market will go sideways to try to build value, because as the earnings go up the 1,000% and the 45%, if as long as the stock price stays the same and earnings go up, it means that the price earnings ratio is going down. So the value in the stock gets better and better the more time goes on. And it's going to take probably 6 months to a year before we build enough value into Tesla that we see another bull run like we saw over the last couple of months. So can't give you advice on YouTube, so I won't, but that's what I think is going to happen to Tesla over the next 6 to 12 months. Hope you enjoy this. If you did enjoy it, please subscribe. Please give us a thumbs up, and we'll talk to you later. Thanks very much. Bye-bye.